Nvidia is in a box, or more of a rectangle. Since October of last year, 2024, Nvidia has basically been trading in a range, a sideways moving range. And this week it hit the top end of the range and then gave it all up and closed down yesterday by just over 3.5%, filling a gap that was made earlier in the week. So where are we headed? I believe because short interest is so low right now, there's not a lot of power to push it higher. When you have a lot of short interest, people shorting the stock, an event can cause it to go higher. Positive events, when a stock is heavily shorted, force the short sellers to actually buy back that stock, pushing that stock price higher. The problem right now is there's short interest is actually pretty low. So there isn't a lot of basically compressed spring to push it higher right now. And that's why I believe Nvidia is trading in this sideways range. The other part of this are the institutionals basically getting rid of downsizing their positions in Nvidia because they've made a ton of money in a year. They're getting out, they're taking their profits. They can offset those profits with losses throughout the year, minimizing their tax exposure. So taking profits, like we saw the last 2 days, Thursday and Friday, taking those profits and redistributing those assets elsewhere to create a better position and diversify their positions out. Because you get so big in one position, well, you can blow yourself up. And I believe right now we're going to continue to trade in this range up until their earnings in February. The other part of this is Nvidia in particular, and really all of the Mag 7, are expensive. Its price to earnings ratio, or P ratio, is up over 50. That's a lot. Technical stocks or technology stocks are typically fairly valued in the 30s. So there's a good chance we'll see Nvidia pull back and get down to an affordable price range when it comes to price to earnings ratios. Let's say you're a long-term holder of Nvidia. You've made a ton of money this year or this past year. What do? The worst feeling is when you lose your profits. If your position is in excess of 5% of your overall capital, it may be advisable to reduce your exposure to 5 or 4% of your overall capital. I know people who have exposure of 20% to Nvidia because they've made so much money. It's time to start taking those profits and wait for an opportunity to buy it at a cheaper price. Remember, you're managing your long-term wealth. When you have profits and they're sizable and your allocation to that position is way out of whack and it's a majority of your overall holdings, be a prudent investor and preserve those and bring your holdings down. It doesn't mean you get out of it 100%, but when you're at the top end of a range, especially in the last year, you're up 170% if you bought it a year ago in Nvidia, you've made a ton of money. Don't lose it. Be a smart investor. Wealth manage. This is what we teach at Best of US Investors Platinum channel. Hit the link in the bio, learn about it. We have a 14-day trial and try us out. Whatever you do, preserve your wealth, be a prudent investor, and always live loud. See ya.